This month's quick tip will clarify the difference between a Fed rate cut versus a mortgage rate cut. Fed controls the Fed funding rate, which is the interest rate that banks charges each other for an overnight loan. It is short term. So after a rate cut, you will see immediate impact to some loans like home equity line of credit cards, or auto loans. However, mortgage, on the other hand, it's long term. While Fed rate cut can lead to a mortgage rate drop, but it's not guaranteed and it's not one-to-one ratio. A 1% Fed rate cut doesn't translate into a 1% mortgage interest rate drop. Mortgage interest rates are influenced by something more long-term, like inflation, like economic data, like job and labor reports. These paints the picture of a future economy. Another interesting factor is expectations. So when the markets are expecting a Fed rate cut, the interest rate will already start dropping before the Fed even announces it. However, when the Fed announces with a no rate cut or less rate cut than expected, the interest rate actually will go up. In short, Fed rate cut can lead into a lower mortgage interest rate. However, it's not always in sync. That's why it's important to stay informed and get educated. Follow us and get the latest tips to make a smart home buying decision.